Box will report results tomorrow. To prepare, we're going to take a look at where consensus estimates stand relative to management's guidance, and we're also going to take a look at the trend in management's guidance versus actual results. To do this, we'll be using our box earnings model. If you're new to our modeling approach, please visit our website, gutenbergresearch.com. You can click on the Education tab and go to our Financial Modeling 101 article, which explains our entire approach to modeling. And while you're there, you can also click on the Free Models tab and take the 3 easy steps to register. And at that point, you'll have access to our box model as well as all the other companies that we cover. You can just click on this button here, and you can see that the Excel file downloads. So going back to our model, let's start by taking a look at the trend in management's guidance versus actual. So Box has only been public for a little over 2 quarters, so there's not a whole lot of data that we can go on, but there is a trend here. They tend to beat their estimates, so it seems that they're a bit on the conservative side at this point. You can see the fiscal first quarter 2016, the guidance that they gave prior to the release was between $63 and $64 million of revenue, and they came in at just better than 65, which beat their own estimate by about 3.3%. And then the fiscal second quarter, they also beat by 5.8% on the revenue line. Right now, they gave guidance of $76 to $77 million for revenue for the fiscal third quarter 2016, and consensus estimates stand at the high end of that range at 76.8. But again, if they beat it by 3 or 5%, there'll be a nice beat to consensus estimates. For the operating margin, they gave us guidance for this quarter of a loss of 49 to 50%. In the past, they've also tended to be on the operating margin, so they're still far from profitable. It's extremely expensive for them to acquire new subscriptions right now. Hopefully they can grow into those costs, but they have tended to beat, so that's a good sign. Now they also give guidance for diluted share count, and once you have the diluted share count, you can make some estimates. In this case, everything that's below the non-GAAP operating margin line, you'd have to make some estimates for those 3 items, which are effective tax, interest expense, and other expense. And when we kept those constant with the recent quarterly averages, we get a loss implied by management's guidance of about 32 cents a share. And you can see that's pretty much comparable with the consensus estimate of a loss of 31 cents for the next quarter. So we're basically in line with management's guidance headed into this release. Now management also gives guidance for fiscal year 2016, which they've been updating over the last couple of quarters. And you can see that they continue to increase their guidance. So they started with a range of 281 to 285 million. That increased to 286 to 290 in June, and then they increased it again to 295 to 297 in September. Now for the operating loss, continues to narrow, going from 50 to 52% down to 47 to 49%. So that's a pretty solid trend over the last year. Keep in mind, this will actually be the first time that management gives guidance for the full fiscal year 2017, so that could really move shares. We'll have to just wait and see if that comes out to what the current consensus estimate is. Now let's take a look at our earnings model. Something important to note here, it's a little bit different on the valuation side because this company is a newly public company and they are operating at a loss right now. We can't really apply a typical price earnings multiple since there are no earnings. So what we've done is we've applied a price to sales multiple, and we stripped out the net cash or debt per share. So right now they're at a positive net cash per share scenario, but as they continue to fund their growth, that could definitely switch over to a net debt position. And in that case, we don't want to create a valuation benefit by applying the same multiple that we did before. So we've just stripped out the net cash from the valuation of the earnings capacity here. So right now our model will not be sensitive to changes in operating margin because it's based on that top line revenue item. and it doesn't take into consideration the changes in profitability. So you'll want to adjust this multiple. If it looks like the company's losses are expanding or it's just not narrowing and not approaching break even, then this multiple would have to contract a bit. So heading into the release tomorrow, shares are trading at about 4.3 times the next 12-month consensus sales estimate per share, and that's on an X cash basis. So now let's scroll back up to the top of the income statement. You can see for revenue, this is in line with management's guidance. It's at the high end of the range, and that's because we have this model calibrated to consensus estimates. Then you can see we have some non-GAAP adjustments in here. If you want the details of what that includes, you can scroll down to our non-GAAP analysis section, and you can see that for next quarter it's basically made up of stock-based compensation and some amortization of intangibles, and this is a consistent adjustment to what we see with other tech companies, so nothing out of the ordinary there. And we've made some assumptions for the different operating expense line items, but essentially we're getting back to what the guidance management gave for total operating income margin on a non-GAAP basis. So you can see again, they expect it's going to be between a loss of 50% and a loss of 49%. In order to get back to the street's EPS estimate, we had to set it to a loss of 49%. So not exactly the midpoint of where management's guidance was, but still in line with guidance. There's one other interesting thing to note here. Since we don't have a lot of data, since they've only been public for a couple of quarters, we really are just modeling the revenue based on a quarter-over-quarter growth rate. But after this, we get these third quarter results, we'll have this quarter's change in deferred revenue, we'll also have the billing growth rate, and even more importantly, we'll have the retention rate. So once we have that, and they also show it on a comparable basis, so we'll also have October of last year, and then from there we can triangulate what the fourth quarter was using the fourth quarter totals, and then we can start to have we can model earnings based on the change in retention rate, change in deferred revenue, and new subscriptions added. So they don't give us new subscriptions added, but we can basically calculate what that implied rate would be. So that'll actually improve the model quite a bit. So that's where we stand headed into the release. Please check back after the conference call when we update this model. And thanks for watching.